Metal stocks like Tata Steel, Hindalco and JSW Steel sign as China cuts benchmark lending rates for the first time in 7 months.
Quest Corp is down 10% as it sees an exceptional loss for around 157 crores in the fourth quarter due to the demerger costs. The management tells CNBC-TV18 they expect to deliver double-digit growth in FY26.
DLF climbs more than 5% after a good set of fourth quarter numbers. Net profit climbs 36%, booking surge 40%. Brokerages Morgan Stanley and Jefferies also issue bullish calls on the stock.
Restaurant Brands trades with a gain of close to around 4%, following a strong performance from its India business in the fourth quarter. Brokerages like CLSA have raised their target price on the stock to 117 rupees.
DOMS slips more than 5% on a sequentially weak fourth quarter where profit declines over 5% and margins disappoint.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. The market's trading with a bit of a red tinge, but not to worry too much, I think. So there is some routine profit taking that we're seeing, currently holding at around 24,700. Mangalam?
Nothing really to worry about as far as the frontline indices are concerned. Very close to support zones for the market right now. The broader markets as well, are on an even keel when it comes to advances and declines. The only thing we'll have to watch out for, whether the Nifty bank, takes support at that 55,000 mark once again and sees a bit of a bounce from there or not. All said and done, a decentish sort of screen despite the sort of subdued tones that we're seeing on the frontline indices. Let's talk about Jupiter Wagons. The company has seen revenue decline from by about 6.5% from a year ago. Margins, however, have seen a bit of an expansion. Joining us to discuss the fourth quarter, but more importantly, the next year in detail, we have Vivek Lohia, who's the Managing Director, joins in. Vivek, thanks a lot for joining in. Two-part question. On FY26, what's your prognosis on execution of Wagons and wheel sets? What's your order book right now? And on the back of that, what's your revenue outlook?
Yeah, good morning. So we are very bullish on FY26. In terms of order book, today order book stands above 6,000 crores. During the year, we expect a sizable tender from Indian Railways because the demand is very strong and Indian Railways has been investing a lot on the freight infrastructure, especially. On the wheel business, we continue to expand. Already this year, we did a turnover of above 300 crores in that business, which we plan to double in FY26. A project in Orissa, which is a completely integrated wheel setup, is supposed to be already, it's under the construction has started. By beginning of next year, we expect the axle line to get commissioned. And in 27, we expect the entire plant to get commissioned. We are very, very bullish on that business. As you can, today the biggest challenge for us is availability of wheel set. Because this year itself, in the last quarter, our production suffered, and during the first quarter also, we have taken a hit in a production capacity because Indian Railway was unable to deliver us the prerequisite amount of wheel sets which we needed. We expect it to improve in the coming months. So we expect the production to stabilize in the coming months. And
Okay.
Our target is to,
Yeah, Vivek, let's get a couple of numbers. You've given us some color on the wheels business, as you said. You're expecting it to double to 600 from around 300 crores. A couple of quick questions. For the business on the whole, what kind of a growth are you guiding for? That's on the revenue growth. Also, in terms of profitability, what should the steady state margins look like?
Today, our margins will be around the current band which we did last year. There's already quite a big expansion. If you can see, there's roughly about a 10% increase in margins which we had over FY24. And if you compare to the industry, we have about a 3 to 4 basis point spread over the rest of our competitors. So our margins are very strong, and that is because of the kind of backward integration which we have entailed over the last couple of years, as well as the other growth drivers which we have.
Vivek, you want to quantify it? Margins, we got it. It'll be in this vicinity. That would be, I think, around 13-14% approximately, right? Around
Around
14%.
14 plus.
14 to 15% we should work
14
with?
to 15% is what we
Got
are
it.
targeting.
That's out of the way. On a base of around 4,000 crores, what can you deliver this year? Already from the wheels business, you'll get 300 crores extra. So that's, some part of a boost. You'll end the year, what? Closer to around 4,500-5,000 crores or more?
So that's the target to do it. Again,
5,000 crores?
yeah,
5,000?
5,000 crores
Got
is
it.
what we are expecting to do this year. And we are pretty bullish on achieving those numbers.
All right, 5,000 crore revenue is what you're expecting in this year with around 14 to 15% sort of margins as well. That implies about 750 to 800 crore EBITDA in FY26. How much of that would convert into cash? Because I'm looking at your operating cash flow. While it has improved from last year, it's still at 200 crores, which is about 40% of what your reported EBITDA is. So what's the kind of cash flow generation from operations that you're expecting in FY26?
So if you see over the last 3-4 years, our cash flows has been steadily improving, and the trend is going to continue. If you look at our inventory holding period, that's come down substantially. We plan to further reduce that because of the more efficiencies which we are bringing into the system. Even our debtor numbers are going to come down this year. So definitely you will see, again, to quantify in terms of percentage right now is very difficult, but definitely you will see a substantial improvement on that.
And you were talking about the Indian Railways giving a big order. Which quarter you're expecting it in? And in fact, if you could tell us what is the potential size that the Indian Railways could give, and out of that, how much can you garner?
So if you see again to specify size, it's very difficult. But if you look at the projections which is done by Indian Railways in terms of the traffic expansion, and so they are talking about they will need at least about 50 to 60,000 wagons to fulfill the revenue targets which they have in mind. So I don't know how much of that will convert into orders. But definitely, I think now the outstanding which is the industry has with the Indian Railways is declining. So we expect Indian Railways to come out with new orders.
That's your expectation. There is no formal notification from the government about any order tendering that is happening, right?
No, because right now still
Got
there
it.
is about close to 40,000 wagons which is outstanding with Indian Railways.
And
The
what is
industry
your
has to
right to
deliver.
win here in Wagons? Just wanted to understand because there are other players as well. You have some share. And this morning itself, we got the news that Shyam Metallics, another person, is looking to enter the manufacturing of wagons. So it's not necessarily going to be an easy road with a lot of competition coming in, right? So how do you then, define your market share, success, and perhaps margins in a business like this, which is seeing a lot of competition?
So, see, competition in any industry is inevitable. So you cannot, but however, the kind of backward integration as well as forward, which we have achieved over a large many number of years. And these things you have to understand that take a lot of time. It's a 5-year, 10-year cycle because there's a lot of certification, there's a lot of learning, knowledge. Today we are so if you look at a wagon which we produce, about 80% of the value addition which happens into the wagon for us is captured in house. From the brake systems, from the entire castings which we do, from the cold roll processes which we have implemented. So these are things which take a large many number of years, and now we are doing a lot of new wagon designs ourselves. So this is something it's not easy for anybody to come and replicate on day one. So there's a huge advantage which we have, and competition is going to be there. It's been there. It's not that over the last 4-5 years new players have not entered the industry. They have entered the industry, but once they come in, they realize that it's not very easy to get the economies of scale and the kind of integrations which we have put in place. And now plus the wheel set being added, and then and then for us the focus is not only the Indian market. Now with the brake systems and the wheel sets, we have a very strong global presence. So it's not only a India market, it's India plus one. It's the European as well as the North American market which we are looking at. So that gives us a vast scope compared to any
Okay.
player who comes.
Got it. Got it, Vivek. Appreciate you joining in. We'll hold you to these numbers. Close to 5,000 crores of revenues, margins of 14-15%, and operating cash flows improving. Thanks a lot for joining in. And we request you to join on back on the channel once you get those orders that you're talking about, the large orders from the Indian Railways. We look forward to our chat at that point of time. For the time being, we slip into a short break. Actually, before that, let's get you a few ideas for profit in our special segment with Moneycontrol Pro. Jitendra Gupta, Moneycontrol.com, joins us to talk about a stock that he's tracking closely. Jitendra?
Hi, thanks. Ion Exchange, a leader in water treatment space, having presence in engineering, chemicals and consumer products, is strategically expanding through acquisition, global push and of course capacity expansion. Moreover, business is doing well. In the first 9 months of FY25, the company's revenue jumped by almost 22%. Engineering, its largest segment, rose close to 34%. EBITDA margin came in at 11%, with net profit jumped by almost 18%. The company has good revenue visibility. It is sitting on an order book of close to 3,400 crore, with key sectors like infrastructure, metals, energy driving overall demand. The Sri Lankan project is almost done. Its 400 crore raising expansion in Roha is almost over, which would of course lead to higher growth in chemicals business in FY26. Going forward, engineering revenue is expected to grow 15 to 20% in FY26. Margins are projected to touch 12% on a higher scale, and of course jump in exports. The consumer division is also scaling consistently, leading to a better profitability. The stock has corrected from high of 740 to current levels. It is trading at just about 20 times its FY27 estimated earnings. Given the growth visibility, margins, tailwind and global push, it could be a good bet at current price.
Right, Jitendra, thanks a lot for that. With that, we'll take a short break. On the other side, don't go anywhere, because we have another management with you as well, or joining us as well to discuss their fourth quarter earnings. Mehul Mohanka, who's the MD and CEO of Tega Industries, joins in.
Welcome back. You're tuned into Chartbusters. The next company on our radar is Tega Industries. The company, well, they're guided for around 15% revenue growth. It's come in a little bit lower than that. However, the margins have come in at multi-quarter highs in the fourth quarter, and the street seems to have caught on to that. To discuss the numbers, the way ahead, we're joined by Mr. Mehul Mohanka, the MD and CEO of the company. Hi, Mr. Mohanka. Good morning. After a while, we're chatting, and it's good to have you on the show. Give us a few details, though. Going by the start of the year, we're already a couple of months into the year. For FY26, what kind of a growth are you looking at? And if you could split it up for us in consumables as well as your equipment business, what kind of growth can you look at in both these two verticals? Please go ahead.
Sure, happy. So, as you know, in FY25, we delivered a double-digit growth, which is of 11%. And our gross margins have held steady at 57%, and EBITDA has moved up to 23% from traditionally being at about 21%. So the quarter four was very healthy for us. And if you actually look at our 5-year growth trajectory on a CAGR basis, we've been in excess of 15%. And we're looking at FY26 to be equally strong, to be anywhere between 16 to 17% growth over FY25. In terms of consumables and equipment, we're looking at consumables to be at about 15% growth, and equipment should be in excess of 25%.
All right. So that obviously tilts the favor or tilts the scales in favor of equipment in terms of contribution coming ahead. Margins, you said 23% margins is what you've done in the fourth quarter. Typically, you guide for a 20 to 22% band. Just wanted to know whether this will structurally improve as your higher margin businesses increase in contribution. And when you speak about higher margin businesses, Dynaprime, how did that grow in FY25? You had guided for what, 25 to 35% growth out there. What's your target here?
So Dynaprime for us grew in excess of 28% in FY25, and we're seeing continued traction for that product segment going into FY26 as well. So we would expect it to continue to grow at those levels even going into FY26, though the base has moved up, but the growth rates will remain the same.
25 to 35%.
Yes.
All right. Give us a broad understanding then in the consumables business. Earlier if we had looked at the mill liners, I think the mill liners and non-mill liners were in the ratio of around 70-30. That's the last number that I have.
Yes.
You could tell us where do you expect this ratio to stabilize at? And Dynaprime, how much is it contributing currently? And where does it head to since it's growing at such a fast clip?
So I think the ratio will remain around 70-30, maybe move up more around 65-35. But we don't expect it to change dramatically over FY26. And Dynaprime, as I mentioned, we have multiple opportunities right now where we are trialing the product with new customers in different geographies. And all of that, which were wins in FY25, will convert into orders in FY26.
How much does it contribute right now?
So Dynaprime, I think, is about close to almost 45% of our entire mill business. And I think it will continue to be trending around those levels between 45 to 55%.
Okay, interesting. It's been a while since we spoke actually, Mr. Mohanka, because the last time around it was, I think, in the 30s and now it's at around 45%. So clearly that's growing very, very well. If you could help us with your updated market share, are you outgrowing the industry? And if you could tell us how much exposure do you have to the United States as of now?
So market is growing at, our estimate, though there's no credible data in the space, but we expect it to be growing at about close to 1.5 to 2%, while we're clearly growing at like, for example, FY25, we were growing at 11%, and it's going to be a stronger outlook for us. So we're completely outstripping the industry average.
So you'll be gaining some market share, right? Going by the data. As per your estimates, what should it be? It was at around 5%. Do you think it's headed?
We put ourselves at about close to 7.5 to 8%.
7.5%. All right. And double digits by when, since you're outgrowing the market?
So we expect at least by FY28, by the time our Chile capex comes completely online and the plant is stabilized, we would expect it to grow into double digits by then.
And what is the likely turnover from Chile once the capex is completed? How does that aid your overall businesses? And to add to what Nigel asked about US, how much does that account for in your overall sales? And is the tariff-related uncertainty going to impede your growth there?
So Chile at full capacity will be about 1,000 crores by the time it comes online completely. As far as US tariffs are concerned, Tega, as well as all other peers in our industry, export into the US. We don't have any local manufacturers. And our overall exposure to the US market is a very insignificant amount of our total percentage of revenue. So going forward, we don't see a material impact on the tariff. Whatever it be, in whichever form, I think it'll be applicable to all our peers as well. So I think there's going to be a neutrality effect on the pricing per se.
And when does the entire Chile thing come on board? When does that start contributing to your revenues?
We expect it to go into commercial production by end of Q2 of next fiscal of FY26.
All right. Okay. All right, Mr. Mohanka, one quick question on this equipment business. It's a bit of a turnaround story out there because you'll have taken over this business and the results are showing as well. So kudos to you as well as the team. Can margins improve further from here? I'm looking at your Q4 numbers. They look blockbuster. You're going at a run rate of around 80 crores per quarter and the EBIT margins are at around 16%. Scope to improve?
Yeah, we see it, at least there's scope to improve by about 200 basis points. And that's what the attempt will be this year. When we first bought the business, it was at 5% EBITDA. We improved it to 9%. And now it's at 13%. So I think it continues to grow. And our aspiration would be to at least add another 200 basis points incremental margin expansion.
So what does that do to your margin guidance? We didn't get the outlook here. Should we look at that 20 to 22% range structurally increasing to 22 to 24% and thereafter beyond that as well? What's the steady state outlook here?
Yeah, I would say it would, from us guiding it around 20 to 21, we would say now we would be more optimistic to say it would be between 21 to 23%.
21 to 23 for this year and thereafter? Yeah.
And thereafter we expect it to continue to stay at about 23 to 24% odd levels, but I wouldn't try to outreach myself at this point.
All right. And what's the order inflow that you expect this year as well? Your current order book is close to around 1,000 crores.
Yeah, so we closed March at about 1,030 crores and we're seeing steady demand for our product lines. As you know, gold and copper both continue to remain strong, and we have enough and more demand that we see from customers for the order book to continue to remain strong going into the subsequent quarters.
Okay, all right. Appreciate you joining in, Mr. Moenka. Thanks a lot for joining in. And in fact, we'll hold you to these numbers. But going by the tone of it, it appears you're quite optimistic on the prospects of business. For the time being, though, we'll have to slip into a short break. As we do that, well, there's some good news for all our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app from the Apple Store or from the Google Play Store, or you could simply scan the QR code that's up for you on the screen.
Welcome back. Even as the markets are slightly under pressure, no real pressure actually, it's just meandering around the flat line, just slightly below that. The broader markets, we've seen a couple of stocks, take off right now. We have Thomas Cook, which is up 5%. This week it's up 10%, 15% for the month so far. We've seen decent traction for names like Kitex Garments, which is up around 5% as well. And Godfrey Phillips reported a very good set of numbers sometime last week. Thereafter saw some profit booking after a big run that the stock's seen. This year itself, the stock is up nearly 66%. And now it's taken off once again, up around 6%. And finally, we have DLF. Good numbers coming in, being rewarded, up around 4.5%, Nigel.
The color is green, Inox green. Just pull up the intraday chart out there. What a move we are seeing. I don't know what's going on there. But Inox green is suddenly spiked up, and most of that spike has come in the last 30 minutes or so, and the volumes are very, very large. So I'll keep an eye out on that. IDBI Bank as well is moving up. Now it's up close to on 2%, but majority of that move has come in the last few minutes. And on the flip side, I saw Zensar. It's cooled off a little bit actually. It was up close to around 8%, I recall. Now it's up around 6%. So it's seen some kind of cooling off from the top, and adding to the list, I think Kochi Shipyard as well as Edelweiss Financial, both of them have slipped into the red.
Just one word on Eternal, Nigel. Eternal's moved to the low point of trade. We have the, results from the shareholders meet. The company had sought shareholders' approval after the board approval to cap their foreign investment holding. Once this happened, the fear was that there could be outflows on account of passive flows if it is excluded from the MSCI, etc. $1 billion worth outflow, and that exactly is playing out. Not entirely unknown, but it is now playing out. So that's what's reflected in the stock price.
Okay, all right. That's it from Mangalam and myself on Chartbusters. You stay with us, though. We are going to wrap up on this edition of Chartbusters, but Trading Hour, the team is waiting by for you.